Welcome to Geoscope. The 2025 nickel tariff war has sparked one of the fiercest US-Canada clashes in decades. A sweeping 20 to 30% duty on critical metals, nickel above all, sent shockwaves through Detroit's battery belt, inflating costs and pushing EV prices out of reach. Canada, once America's steady supplier, struck back, diverting exports toward Europe and Asia while fueling its own industries. Now, with whispers of tariff exemptions surfacing, the battlefield is shifting again. Buckle up. Here are the pivotal moves, sharp counterpunches, and what this showdown means for the future of EVs and the auto world. The US-Canada auto supply chain was a model of integration, a finely tuned engine of prosperity. At its heart, a vital artery of nickel flowed south from Sudbury's rich deposits. This high-purity Class 1 nickel, essential for modern batteries, quietly powered Detroit's EV ambitions. In 2024 alone, $3.9 billion worth crossed the border, a silent partner in every Tesla pack and GM Ultium cell. It was a relationship taken for granted, the bedrock of North America's green transition. Then, in August 2025, the engine seized. A sweeping tariff policy aimed at China was enacted, but in a move that stunned observers, its wide net also ensnared America's closest ally. Suddenly, Canadian nickel faced tariffs of up to 30%. A policy intended as a shield had become a sword against its own supply chain. The math wasn't just brutal, it was a self-inflicted wound. The impact was immediate. The workhorse of the American EV fleet is the NMC 811 battery. A typical SUV pack needs about 38 kilograms of high-purity nickel. Before the tariff, that nickel cost automakers around $800. With a 30% levy, the cost instantly jumped by nearly $250 per pack. It was a direct tax on the most expensive component in an EV, with the cost passed down the line. For automakers on razor-thin EV margins, this was a body blow. At GM, which had bet its future on the Ultium platform, projected margins shrank from 10% to barely 8.5%. That small drop represented billions in lost profit, money earmarked for R&D. Across Detroit, the story was the same. Analysts warned of 94,000 fewer EV sales in 2026 as sticker prices jumped. The fallout landed on showroom floors. Ford's F-150 Lightning, the symbol of the electric workhorse, saw its price soar. A model once forecast at $67,500 now topped $72,500, pricing many households out. Suddenly, the gas-powered F-150 next to it didn't just look like a bargain, it looked like the only sensible choice. The tariff was actively undermining the green transition. The irony was staggering. A tariff billed as job protection instead shrank sales, gutted margins, and cast doubt on Detroit's EV future. The artery of Canadian nickel had been pinched, and the heart of America's auto industry felt the strain. But across the border, shock was turning to resolve. Canada, holding a critical mineral resource, wasn't about to idle. While Washington expected drawn-out negotiations, Ottawa skipped the rhetoric and went straight to action. Recognizing the old trade paradigm was broken, the government responded with a calculated economic counteroffensive. In July 2025, 4 decisive measures were unveiled, designed to reshape the trade battlefield. First, a 15% export tax on raw nickel. This specifically targeted the high-purity Class 1 nickel essential for American EV batteries, ending decades of duty-free supply. Overnight, U.S. cathode makers saw their primary source become significantly more expensive, sending shockwaves through their cost projections. Second, a masterstroke of policy, new carbon tracking rules. These regulations favored Ontario's hydro-powered green nickel. This brilliantly framed a trade advantage as an environmental imperative, creating a premium for Canadian nickel while pushing dirtier, carbon-intensive output from global competitors elsewhere in the market. Third, a strategic pivot. A $257 million CAD fund was launched to boost LFP battery production. By investing in this nickel-free chemistry, Canada began reducing its own dependency on the mineral, insulating its future EV industry from the very price shocks and geopolitics Washington sought to exploit. And fourth, securing the industrial crown jewel, a package of powerful tax incentives was finalized to secure Stellantis LG's Windsor Gigafactory. This move guaranteed that thousands of high-paying manufacturing jobs and the entire supply chain supporting them would be anchored in Canada. The cumulative effect was immediate. By July's end, global markets had reacted, and analysts projected $1.8 billion in redirected trade away from the US and towards South Korea and Europe by 2027. Eager to secure their supply, manufacturers in Seoul and Frankfurt rushed to sign new long-term agreements. Then came the knockout. Prime Minister Mark Carney announced a 5 billion CAD Buy Canadian program. This initiative mandated domestic sourcing of key minerals for any company receiving federal green tech subsidies. It created a powerful, self-reinforcing economic loop, making access to Canada's market conditional on investing in Canada itself. Europe and South Korea surged as customers, while America's share shrank. In the end, this wasn't just retaliation, it was a sophisticated strategy of diversification, investment and industrial planning. It was a strategic pivot, skillfully turning Washington's tariff into Ottawa's decisive long-term advantage and a masterclass in economic statecraft. Tariffs were only the opening punch. Carbon costs loom larger. In 2026, the EU's carbon border adjustment mechanism will slap €115 per ton of CO2 embedded in imports. For US automakers reliant on Indonesian or Philippine nickel, that's a financial landmine. Ontario's hydro-refined nickel. 4.2 tons CO2 per ton of nickel. Indonesian laterite nickel, 36 tons, nearly 9x dirtier Chinese average. 18 tons EVs built with dirty nickel could face hundreds in carbon penalties when shipped to Europe, eroding already thin margins. Meanwhile, Canada is capitalizing, inking long-term deals with Germany and South Korea for tariff-proof, green-certified nickel. Layer in Russia's war, Indonesia's environmental baggage, and China's refining dominance, and Washington's tariff looks more like a misstep than protection. Just as tensions peaked, a surprising twist emerged. On September 5, 2025, facing domestic pressure, President Trump signed an order enabling tariff exemptions for aligned trade partners. Nickel, the lifeblood of EV batteries, made the list, offering a glimmer of hope. But in a pointed political maneuver, Canada wasn't automatically guaranteed a slot. The message from the White House was clear. Any relief would require significant concessions, leaving Canada's multi-billion-dollar industry in a state of high-stakes limbo, forced to negotiate for its economic survival. Prime Minister Carney responded quickly with a calculated two-pronged strategy. In a major olive branch to Detroit, he paused Canada's ambitious 20% EV sales mandate for 2026, easing pressure on automakers. This signaled a clear willingness to negotiate. Simultaneously, Carney launched a $5 billion Canadian relief fund. This financial shield was designed to protect the nation's vital nickel mining and processing sectors from the immediate fallout, safeguarding thousands of jobs while the government engaged in tense, back-channel diplomacy. Wall Street reacted with cautious optimism. Analysts pegged the odds of a deal at 60%, with trading floors buzzing over two likely outcomes: a full exemption or a compromise in the form of a blended 20-25% duty. But for the auto industry, the damage was already being done. Unable to wait for a political resolution, General Motors trimmed its 2026 EV outlook by 15,000 units. This wasn't just a forecast adjustment, it was a tangible $3.2 billion hit, a direct consequence of the nickel uncertainty. The GM announcement sent shockwaves through the industry, dramatically increasing the pressure for a resolution. The standoff is now tilting decisively toward negotiation. Detroit's state-of-the-art factories can't sit idle forever. This conflict has exposed deep vulnerabilities in the North American EV supply chain, all hinging on a single critical mineral. The entire episode forces a much larger, more urgent question. As the world electrifies, who really controls the future of nickel? Is it the nations that mine it, or the superpowers that weaponize it? Nickel isn't just a metal, it's a geopolitical lever, and right now, Canada holds the center of the board. Contracts with Seoul and Hamburg are diversifying Ottawa's buyers. Europe is embracing Ontario's low-carbon nickel. South Korea boosted imports by nearly 20% since spring. At $20.20 per ton, nickel is critical for EVs, aerospace, and defense. Losing secure Canadian supply could push America toward riskier Russian or Indonesian sources, a national security concern. Meanwhile, rising EV prices risk turning electrification into a luxury market rather than a mass transition. Canada has safeguarded its position as a green supplier of choice, while the US risks both competitiveness and credibility. What began as a tariff meant to shield American jobs has ricocheted across Detroit, raising costs, stalling EV adoption, and destabilizing supply chains. Canada, instead of folding, doubled down, diversifying exports, investing in cleaner tech, and using nickel as both shield and sword. Now, exemptions are on the table. The US must decide, rebuild cooperation with its closest ally, or risk ceding the EV future to Europe and Asia. The Nickel Gambit proves one thing: resources once buried underground now shape industries, alliances, and climate goals. Now over to you. Will Washington grant Canada a tariff exemption, or let the standoff drag on? Has this nickel war reshaped your view of EV affordability and America's leadership in electrification? Share your thoughts in the comments, and don't forget to subscribe to Geoscope for more deep dives into the geopolitics of trade, resources, and technology. Thanks for watching. See you next time.